Hey everyone, Clint here, editor of Flashpoint Fortunes and research analyst for the Bauman Letter. Well, Ted is out today, so I will be bringing you your Bauman Daily Friday video. Now, before we get started, please check out the link above my left shoulder in the top right of your screen. You can learn how to get started with the Bauman Letter there. We offer a very diverse range of stock picks in our model portfolio, everything spanning high income to high growth opportunities. So once again, all you gotta do is click the link above to learn how to get started there. Now, for today's topic, I wanna talk about the beginning of the end, or is this the beginning of the end? As it pertains to some of the Federal Reserve's extraordinary stimulus measures that they've had in place to combat the impact that the pandemic has had on the economy. And it's Thursday as I'm recording this. It's going to be Friday morning as you're watching this, and Fed Chair Powell is either just beginning or just wrapping up what is a widely anticipated, closely watched speech about the economy from the annual Jackson Hole, Wyoming symposium that they're doing now. Last minute, they had to scratch the in-person meeting at Jackson Hole that was planned. Instead, this year it'll be virtual. That's because of the spreading Delta variant, and so it's interesting how that's going to play into some comments that I have about the situation that the Fed is facing right now. But the reason why this is such a closely watched meeting is because Fed officials have been laying the groundwork to start to back off of some of their measures they've been taking, namely the quantitative easing stimulus that's out there. You know, they're creating $120 billion a month in new money to go out and buy government debt securities, and that'll be the first thing to go. You know, rates are going to stay at zero for a long time. This quantitative easing program, that'll be the first thing to go, and they're not just going to end it immediately. They're going to start to taper these purchases. They're just going to start to slow the amount of purchases they're making until it winds down and hits zero. And from there, the rate increases will be some time down the road, but investors are watching for just any clues, comments around when this tapering is set to occur, because then that starts to put into motion the timeline for all the stimulus to end altogether. And there's been just a growing course of Fed officials over the last 2 months that are getting on board with wanting to start to taper these asset purchases and end quantitative easing sooner rather than later. But it's not that simple right now. And so let's get into first sort of this conundrum that the Fed's facing. So the Fed has two mandates. One is to promote full employment, the other price stability. On the price stability front, there's a lot of concern out there right now because we've seen these really hot inflation reports coming in. Now you can very much debate whether or not these things are transitory, temporary, or if they're going to be lasting, because a lot of it just stems to the supply chain issues that we've been facing. And once these bottlenecks are cleared up, there's the expectation that inflation will start to come in, but regardless of the outlook, we know there's concerns out there right now. Here's a chart of an inflation number that comes from a manufacturing survey. So this is the prices paid index for the ISM manufacturing survey, and basically what this means is that manufacturers, it's a measure of how much pricing pressures they're facing, and they're facing the most upside in pricing pressures since 1979. Just the other month, this figure hit over 90. That was the highest level since 1979. Once again, you can see it came in just a little bit in the most recent report, but we've seen the consumer price index, the producer price index. It's just another way to show you how high inflation levels are running right now, and so that's causing concern from that price stability aspect of the Fed's mandate. Now, the other mandate is on the employment front, trying to get to full employment. And while we're not there yet, we're making good progress. The unemployment rate has dropped down to 5.4% in the most recent payrolls report. If you want a more real-time look at what's going on in the labor market, initial jobless claims is a great spot to go to. Today, they came in at, I believe, 353,000. Yeah, 353,000. Here's a chart of jobless claims just so you can see kind of where we are versus where we would be in more normal times. You get that big spike up during the pandemic, but we've since come in once again running at 353,000, and sort of a normal state economy, at least before the pandemic hit. This figure was in the low 200,000. So we still have a ways to go, but we've made great progress. So there's those two mandates are what's driving the Fed to want to consider ending some of these stimulus programs. But Delta variant is clouding that outlook. We've already seen a lot of data coming in that suggests the Delta variant is changing consumer behaviors, consumer spending patterns. We saw consumer confidence take a big dip the other week. Retail sales that reported within this past week or so missed estimates to the downside. Economists, they're looking at all this data. They are cutting their forecasts. Actually, Goldman Sachs just recently came out and slashed their outlook for third quarter GDP from, they were all the way up at 9%. They cut that back to 5.5%. And that might still be too high. That's because I was looking at something that the New York district for the Fed puts out. It's called the GDP Nowcast. And it takes a look at all the data that's coming out and tries to provide a real-time look at how GDP is trending for the quarter we're in. So here's a chart of that. This forecast for the third quarter. And you can see we were running at the start of May and into June around that 5 to 5.5% level. But since then, we've been taking a dip lower. We're now running at about a 3.5% level. And once again, there's just a lot of factors related to how the Delta variant and the surge in COVID cases that we're having, how that is impacting the economy and outlook. And so that presents one additional variable, a big variable of uncertainty as the Fed's trying to consider what to do here. And so now let's talk about this Jackson Hole speech that Powell's giving today, how the markets will react to that. But first, let's talk about really what I see as the two main scenarios that can unfold here. One is that Powell strikes sort of that hawkish tone. It shows that the Fed is more concerned about what's going on with inflation. It shows that despite what you're seeing with the Delta variant right now in the economy, they still think they're going to keep making progress to those employment goals that they have. And so, because of all that, yes, this taper of bond purchases, that is going to be indeed happening sooner rather than later, definitely starting this year. And maybe the Fed using this speech or their meeting next month to set the framework for how that's going to unfold. The other scenario is that Powell acknowledges the risks to the economy, risks to their labor goals. Because of what's going on with the Delta variant, it shows they're not as concerned with what inflation's doing, or they are concerned about inflation, but they view the bigger risk right now as the outlook to the economy and wanting to sustain that growth momentum that we've had for so long this year up to this point. So those are the two scenarios. Now, this is how the dominoes are going to start to fall based on which one of those scenarios occurs. If the first one, or the first domino, if you will, is going to be with 10-year Treasury yields. This will be the first thing that I'm watching. I'm going to have this up on my screen all morning to see how yields are responding to this. Because here's what I believe: if Powell strikes that more dovish tone, that stimulus is going to be around for longer. That they're willing to tolerate more inflation. Bond investors hate inflation. If there's more stimulus, that could be a positive for the growth outlook. Higher yields will reflect the growth outlook too. And so here's what I'm watching with the 10-year Treasury yield right now. So here's a chart of the 10-year Treasury yield going back about a year, but we've recently, just over the last 2 months, settled in to this range on here. We've been capped on the upside at about 1.4%, to the downside at about 1.18%. I'm showing that with these two black dashed lines on here. Right now we're running right around that 1.35% level. A couple different lines on here. That black line is just the 50-day moving average. The green line is a 200-day moving average. They're coming right together, creating really just an important area once again as we're trading within this range. Now, if this more dovish scenario unfolds, I would anticipate Treasury yields to spike higher. Once again, reflecting that growth outlook, reflecting the Fed not being as concerned about inflation, wanting to pursue growth instead. And so we trade above that 1.4% range. That would be a key breakout to the upside on the 10-year Treasury yield here. If we go the other way, if it shows that the Fed's more concerned about wanting to get this inflation under control, and they're going to start to act by reining in stimulus, I would expect then this yield, 10-year Treasury yield, to break below the low end of this range. And then I've threw on this chart a couple different momentum indicators. The first panel below the price chart, that's a stochastic. Then you have the MACD, and then you have the RSI. So those are all just gauges of momentum that I'm watching as we monitor how yields are going to respond. So yields are the first domino that falls here. Now here's how this is going to impact the market. The first thing I'll be watching for, if yields break out to the upside of this range, if they climb over that 1.4% level, I would expect to see some downside pressure in the stock market. Stock market valuations do not like rising rates. And there are a lot of expensive mega cap growth stocks that make up a big chunk of these indexes, especially the S&P 500 and the NASDAQ 100. If they start to see valuation pressures from rising rates, I would expect to see the broader indexes falling here, but that doesn't mean everything's falling. If you start to see rates climb, you could see part of this, at least a part of this reflation trade come back to life. This is a trade that worked very well from about November of last year up until about the first quarter earlier this year, and then really hasn't been going earlier. If we start to see a spike up in yields, that could help the inflation trade or reflation trade right here. And the first spot I'll be looking to is with banks, specifically regional banks, because if we see yields climb, you're going to see the yield curve steepen. A steeper yield curve helps net interest margins. It helps profitability for these banks. So one area of opportunity to keep an eye on is with a regional bank ETF, a ticker KRE. And so here's the levels that I'm watching on KRE. This looks at a chart and going back about a year. The solid black line and green line, once again, that's the 50-day and 200-day moving average. And really, this ETF, these bank stocks have gone nowhere since March. They've just been trading sideways to slightly lower. But once again, if we start to see a scenario where the yield curve starts to steepen because the 10-year Treasury yield is breaking over that 1.4% level, I would expect to see this ETF break out over this dash line I have on here. And the 70 level would be absolutely key and critical. I would expect to see sustained upside to this ETF if we see that breakout. On the other side, if we see the more hawkish version of the Fed come out tomorrow, and we start to fall through the low end of this range, and that's going to be the status quo trade that we've had, especially over the last several months now, where the indexes are grinding higher, and really they're just being supported by those large cap growth names. So you could look at in areas like the QQQ ETF to benefit from that scenario, because once again the falling yields, falling rates would be supportive of their valuations. I think the other thing that reflects falling yields would reflect is a slowing or lower growth outlook, and so investors would look toward some of those names as an opportunity to grab growth, because maybe that means the reflation trade is not going to keep working or is going to come back to life as it would in the first scenario. So that's what I'm going to be paying attention to. That's something you can watch tomorrow. Once again, this video should be coming out right around the time that Fed Chair Powell is delivering his speech. So it's something to keep an eye on throughout the day tomorrow and to next week, because I really think this sets up potential change in leadership, or at least how the markets are going to behave, especially here over the coming month as we get into September, which is a notoriously volatile month for stocks. Once again, click the link above my left here to learn how to get started with the Bauman Letter. And that is all I have for you today. This is Clint Lee. Thanks for watching.